This conference will now be recorded.
Good evening to everyone present for the session. So today we have a session on Tally. Yes, on basics of accountancy and Tally. Yes. So all of you are ready so that we can begin the session. And I
Yes,
want to ensure again that is my voice audible?
yes, ma'am. Yes, ma'am.
Thank you. Thank you for your
Yes,
response.
ma'am.
Yes. So today, yes, today it's our first session on Tally. Now, before we begin the session on Tally, what is a Tally software? What is it about? What kind of a software it is? Why it has to be used? So there are a number of questions. So before I begin the session, today, I would like to ask a small question. So don't be okay. Fine. The first session itself, we have the first question to receive, but a small, curiosity. That before I begin the session for the day, let me ask you, any one of you can reply that what's Tally about? Any idea about it? Or you know something? Any guess? One of you can, respond. If there is no idea, also fine, works. Not an issue. Or anything you know, you would like to tell.
Recording account.
Okay, recording accounts. Any other answer?
Recording the transactions in a business
Recording
through
the
an
transaction.
software.
Huh? Yes. And so recording the transactions in a software, that software will be a Tally software. Right. So now some of you told that yes, we record the accounting transactions, and for the same purpose, we use the Tally software, right? So before we begin, what is Tally? What is the software about? What kind of a software it is? Let us go for a small recap, rather I can say a refreshing session on accounts. Yes, all of us are well versed in accounts, have a depth in knowledge of accounts. Fine. But let it be a small revision, of accounts, and then we can begin with Tally. So what you have forgotten, what you're not sure of, what revision you would like to get. So all of that would be covered in today's session before we step into the Tally program. Yes. So let's begin with the accountancy. I would like to know, is the screen visible?
Yes, ma'am. Yes, ma'am.
Thank you for your response. Yes, so we start with the basics of accountancy. Now, all of us are well versed what is debit, credit, what all we record. But there are a few aspects which we need to know before we step into the Tally software. So, whatever accounting basics today we will be covering, it is just not a basic or it is a must and should for a Tally software, but this revision or this learning can make you or can bring you to a comfort zone when you work in the Tally software. So for the same reason, we will cover the basics of accountancy and then we can step into the Tally. Yes, I have a small introduction of accounts. Just now we told that yes, accounting is required, it is essential. For what purpose? So here my first point says it becomes essential for a business owner to keep a record of the business income and expenditure. Yes, so it can be a small tea stall, a big multinational company, whoever it is, whichever concern it can be a small size, medium size, or a large size. Whatever transaction or activity takes place in the business, it has to be recorded by the business owner, so as whatever he has earned, he can record, whatever he has spent, also he can record. So the reason is only one, so that he can know either he has made any profit or he has suffered any loss. Simple. Now, when we talk about the accounting aspect, what is the procedure? What's the stage? How do we start recording? Any transaction happens, any purchase transaction happens, immediately we record it. No, but there has to be some procedure of recording the transactions in a business entity. We start with identifying a business transaction. Yes, all of us are evident. Now, what kind of a transaction it is? It is a purchase, it is a sale, it is a loss, it is a profit, it's a depreciation. Yes. So before we record any transaction in our books, the first step, what do we take? We identify the business transaction, the nature we identify, what kind of a transaction it is. Once we identify, then we will record them, and after recording them, we summarize them in such a way that important financial information can be communicated to the stakeholders. So first goes with the identification, then recording, then summarizing the important financial information. So summarizing, obviously, what is the basic information we require? The date of the transaction, the nature, the party details, then the description of the goods or services, the amount involved, tax involved, etc. So all this information or all this recording is required not only for the sake of us in the sense the company, but also it is important for those parties who are associated with our business. So we term them as stakeholders. Yes. So stakeholders are nothing but our third parties, our suppliers, customers, employees, competitors, investors. Then we have, our shareholders. Then we have the government. So the list goes on, trade unions. So all these people or all these parties are more or less associated with the business firm. Henceforth, recording is necessary of our business transactions so as to give a clarity of our business information to all these stakeholders. So it can be said that accounting is the language of any business. Yes, you take from small to big, whichever, as I told, irrespective of size of the firm, every person makes sure that whatever activity takes place, he makes a record of the same. So here beneath I've given a small chart, right? So accounting starts with recording, classifying, summarizing, reporting, and then interpreting. So this is the cycle we follow. It starts with recording, then classifying, we summarize them, then we go for the reporting, your balance sheets, profit and loss accounts, cash flow statements. Then on that we make the valuable interpretation. Next, why accounts? Now, the previous slide we saw that, yes, accounts is required. Now, is it really required? Or without that, it is not possible to know what profits or losses has been incurred? No. So, if we maintain accounts, we can easily ascertain whether the business is earning profits or suffering losses. Second, how much our third parties owe the business and how much the business owes to the third parties. Yes. So how much the business has to pay the third parties, nothing but my suppliers or creditors in business terms, and how much the business should receive from the third parties, nothing but my debtors or customers. So this clarity also I'll have. Yes. So how much has to be paid and how much has to be received, provided I record. Third we have is this, can the business be expanded? I also get an answer for the same. Now, with the recording of accounting entries, right? If in case a business is in a favorable financial position, yeah, it is earning good amount of profits, obviously it will think of expansion, right? Yes, so the business is earning well, doing good. So the next, thought which comes to a business owner's mind is, yes, let me expand my business. Yes. So the next option or next thought would come for expansion. So fourth, we have is should a specific operation be withdrawn? Yes. Suppose if one of the branches or one of the outlets or because of one of the activities, in case if the business, is suffering losses, it is not in a so good position. So obviously the company will take a decision to withdraw one of the operation which is causing such losses. So all this is possible provided I go for the entry of all my activities, accounts. And most important is the last part. What is the total value of the business assets? The net worth. Yes, the shareholders' funds, the net worth, the capital of the business can be ascertained provided proper accounts are maintained. So we can get a reply for all these questions. These questions are not posed to others, but these are the questions to ourselves. Ourselves in the sense the company itself, right? So a reply will be given provided we have a clarity of our business transactions. That is why accounts is very, very important. Yes. Now here we begin with certain accounting terminologies. All of you would have come across this. Yes, it is common for all of us. We keep on using transaction, cash, credit, yes. But as I told, it will be a small, a revision time. See, transaction is not used everywhere, right? We normally don't say, suppose if you are purchasing any vegetables, for our house, we don't say that, no, I've entered, into a purchase transactions with the vendor. Do we say so? No, I made a purchase, that's all. I never use the word transaction except we go for the banking. But other than that, we don't use the word transaction on a daily basis in case of our personal activities. So we use the transaction where? In business. So moment we say transaction, transaction is business, business is money. So transaction, it's a business activity that involves the transfer of money or money's worth between two accounts. So there is a transaction of money or money's worth between two accounts. Yes, so one accounting aspect is debited, another accounting aspect is credited. So there's a transaction taking place between two parties, two accounts. Now, if I talk about the transaction, here we have two kinds. Which are they? We have is cash and we have is credit. What's a cash transaction? Cash doesn't really mean that there is only physical or the hard cash or however we define. It also means like so in case you're making any digital payments also, right? You have Google Pay, Phone Pay and all. That's all modes of payment, but that is the cash payment, right? So we have the instant payment or instant receipt. So the effect is immediate. It is not postponed to a future date. So such kind of transactions are called as cash transactions. Now, what kind of a transaction is credit? Cash says transaction where money is immediately received or it is paid. As I told, I purchase the goods from a supplier. I pay the amount immediately and it is done. So transaction then and there only it is closed. What about a credit transaction? What can happen? In case of a credit transaction, the goods are purchased, but the payment is not made immediately. It is made at a later date or later stage. In the same way, if I am selling the goods to one of my customers and he agrees to pay at a future date after 2 days or 3 days. Again, such transactions are called as credit transactions. So benefits are received immediately in the sense, if I go for a purchase, I receive the goods immediately. Goods are nothing but benefits. If I go for a sale, benefits are sold immediately. So the possession of the goods, moves immediately or happens immediately. But when it comes to money, it is paid or received later. Next. Yes, so this is a concept which we commonly use, right? Purchase, sales, and all. So what's a purchase? Amount of goods bought by the business for further use or for reselling. Now, if I talk about a purchase, it is what? Amount of goods which are. Yes, Fatima, you have joined now due to network issues. Not an issue. We are still in the introductory stage. Not at all an issue. We are just in the initial stage. Nothing to worry. You can join the session, right? We have not gone very long. We are still in the initial stages, right? So here, if we talk about purchases, we say amount of goods which are bought by a business for further use or for reselling. Now, reselling, I know. Yes, I purchase the goods from a supplier. I will sell it, or I'll sell it for further. Fine. But what do I mean by further use? Reselling is there, right? Purchase from a wholesaler, then sell it, or from a distributor, then sell it to a wholesaler, like that. Reselling purpose. Fine. But what do I mean by further use? What is meant by further use? If I'm purchasing the goods for my business, I have here two aspects, one for further use or for reselling. Reselling is very much clear, but what is meant by further use? What can it mean? Any guess?
Ma'am,
Producing other goods.
can you please repeat it?
You want me to repeat the question again? Now here, I say amount of the goods which are bought by a business for further use or for resale. Yes. So my business is purchasing some stock. That stock can be sold further or it is meant for further use. That's what I've given you in the definition of purchase. What do I mean by further use?
Ma'am, to produce other goods?
Yes, for further manufacturing, for further production, nothing but your raw materials. So your purchase has two or more than three different aspects. I'm purchasing as a raw material, or if I'm reselling, it has to be a finished good. So like this, it has two different aspects. Now here, if I talk about purchases, again same, we have is two purchases. One we have is this cash, another one we have is this a credit purchase. Now, what about a cash purchase? I purchase a stock for my company, make the payment instantly, then and there, transaction gets closed. I'm repeating it again. I'm purchasing the stock for the company. I make the payment immediately, then and there, transaction gets closed. So it has an immediate effect. If I talk about a credit purchase, I purchase the stock from my supplier, but at the time of purchase, payment is not made immediately. I purchase the stock from my supplier. I receive the goods from him, but at the time of purchase, payments are not made immediately. So that is called as a credit. Even though I pay the very next day or even in the evening also, on the same day evening also, it is done fine. But at the time, let's say I purchased in the morning and I have to record the entries, yes. So that time when I'm recording, can I wait till I make the payment? No. Moment it happens, it has to be recorded, right? So In such a case, when purchase is being done and when payment is not made at the time of purchase, it goes for a credit purchase. Next, if we go for a purchase return, so purchases have two aspects. One we have is a cash purchase. Second we have is a credit purchase. If we talk about a purchase return, goods that have been purchased but returned to the seller before the consumption on account of various reasons like poor quality, damage, not as per the buyer's specification. Simple. Let's say one of you or all of you would have purchased a nice dress material or kurta from where commonly you purchase. It can be Amazon, Snapdeal, Flipkart. So I'll just give you a few sites. Of course, you would know much better than me. So example, Amazon, Flipkart or Snapdeal. One of them, I know, I make an online purchase. Now, let's assume that you would have ordered a red kurta, somewhat like that. Okay. Now, when you receive some other color. It will be like bright orange or something like that. Now, would you still receive it? Anyways, he has come and delivered. No, let me receive whatever he has delivered. For sure not. What you will do? Return back to the seller. Why? Because it is not as per your specification, not as per your instruction, right? You book one color, you get some other color. You book one product, you get some other product. So like that, if it happens, will you retain the goods? No, you're going to return it back. Also, when you find some damages, yes, would you keep the same with you? Certainly not. You're going to return it back. If it is of a poor quality, an inferior quality, it is not matching your expectations. Even in that situation, you would return the goods back. All of them count for the purchase return. So reasons can be n number, but whenever the goods are returned to the supplier or to the seller before consumption on account of various reasons like poor quality, damage, or not as per buyer specification, it is a purchase return. Next, we go for a sales return. And sales return. Sales is, now what is purchase? The amount of goods which are bought by the business. Sales is the amount of goods which are sold by a business. So we have again two aspects here. We have this cash sales and we have this credit sales. So same. When I'm selling the goods to my customer, I receive the payment instantly. It becomes a cash sale. Then and there, the transaction gets done, settled. What about a credit sale? I sell the goods, but I receive the payment at a later date. Yeah, it can be the same day, later time or the very next day, whatever it is, it goes for a credit sale. What about a sales return? Same reasons what I've given for a purchase. I've given like poor quality, damage, or not as per buyer specification. So I would hold the same reasons even for sales returns. Yes, I would have sold some stock to one of my customer. He finds some damages or it is of a poor quality. What he would do, he would return it back to me. So that's nothing but a sales return. Yes, so these are the terms for us which holds a huge importance. This commonly all of us would use. Debtor, creditor, stock, revenue. Yes. Sundry debtor, sundry creditor. So, in a layman's language, sundry debtor is equivalent to a customer. Sundry creditor is equivalent to supplier. That's all. No confusion, complete clarity. So in a usual term, in a general term, we define them as a customer. But if we go in terms of our business, right, we term them as a sundry debtor. Similarly, for a supplier, we term them as a sundry creditor. Now, debtor is a person who receives benefits from the business immediately. Yes. So whenever I'm making a sale of goods, but I don't receive the payment immediately from my customer, and he pays at a future date, right? Such person would be termed as a sundry debtor. So a person who receives benefits from business but is obliged to pay at a future date. Creditor, a person who provides benefits, yes, without receiving immediate payment for the same, and who will claim the payment in future. Yes, so I receive the goods from one of my suppliers. I don't make the payment immediately, but I have to pay in another couple of days. So he would pay the payment from me in future, obviously, for the goods he has sold to my business. So the supplier is nothing but my sundry creditor. Next, third aspect we have is the stock. Now, stock actually has three phases. I've given here two. The final one is the nth stage. So first we have this unsold goods. Stock covers three aspects: unsold goods, raw material, and we have this finished goods. Now, whatever raw material we purchase for further processing, for further manufacturing, that also is termed as stock. Yes, we have opening stock, we have closing stock, which you see, which is evident in any trading account when you watch out for. Yes, which is meant for further manufacturing or further processing. Next is unsold goods is nothing but what? Your finished goods. Yes, the manufacturing process is completed and it is ready to be sold. The in-between part, raw materials is the initial stage. The end stage is the finished goods. The in-between part is the work in progress. So all these three aspects are also termed as, or otherwise termed as, stock only. So where we cover all the opening and the closing aspects that lie with the business are collectively known as stock. So depending upon whichever stage it is, we define them as stock itself. So ultimately, the final stage we have is revenue. Yes, earnings of a business through its activities and operations. So finally, we enter into a purchase, sale, any kind of payment of expenses, receiving of any income. Ultimately, the main objective, the primary objective of a business concern is to earn reasonable amount of profits, revenue for the business from the business operation. So revenue is nothing but earnings of a business through its activities and operations. Yes. So the ultimate objective is the earnings only. So that earnings is defined as revenue as our accounting term. So these are the certain accounting terminologies which we will use commonly also in Tally, right? We have the transaction, we have purchase returns, we have sales returns, we have debtor, creditor, stock, and finally we have revenue. Yes. So now we have is the accounting assumptions. So before I begin with the accounting assumptions, right? Assumption means what? I assume things. It's understood. It need not be necessarily communicated. It is understood. Fine, yes. So it is, clear that this situation is there. It has to be, reaction has to be had like this. So it is genuine. So in the same way, we have four accounting assumptions which are normally practiced by any business firm. Yes, we have accounting entity, we have accounting period, and we have the other two, which we will discuss. So first of all, we have accounting entity assumption. So what do we understand by accounting entity assumption? What do we mean by that? I've given here the business and the proprietor are treated as two separate entities. Yes, the business transactions are separate from the owner's personal transactions. In other words, only business transactions are recorded. So first says business and proprietary as two separate entities. I don't mix both personal and business transactions. I record only business. Yes. So I'll give you a simple example for the same. If any one of you would like to give, you can give an example for it. Any of you are interested to give, or I would give the example for accounting entity assumption. Okay. So for the accounting entity assumption, a simple example. Now, if you take any company, you take Reliance, you take Tata, anyone, Reliance works. Now, if you take Reliance Industries, yes, Mukesh Ambani has constructed a house, right, in Mumbai. A house is a very small word. Yes, Antilia is there, which is worth crores of rupees. Now, whatever cost he has incurred for the construction of his Antilia, right, can the same be recorded in the Reliance financial statements? In his profits, he has constructed, a house or a bungalow or however you would like to define. But whatever cost he has incurred, can he record the same in the Reliance financial statements? Is it possible? No. Why? Because, of course, owners' personal transactions are different from the business. Yes. So whatever is meant for his personal use, personal consumption, they don't find a place in the business books of accounts. Now, to run the same business, let's say some furnitures are purchased, some systems are purchased, building is purchased, whatever it is, which is meant for the business use, the same will find a record in the business books of accounts. So even though I spend, a nominal amount of 50 rupees to purchase any stationeries, but still I find a record in my business books of accounts because it is meant for my business use. So accounting entity says that the business and proprietor are treated as two separate entities. Second, we have this accounting period assumption. Now, accounting period assumption, yes. Normally, we have the practice of by 1st of April and closing by 31st of March. Yes, all of us agree with this. We open our books of accounts by 1st of April and close by 31st of March of next year. Now, as of now, what is our financial year? 1st of April 21 to 31st of March 22. One more example I've given here is Jan to December. This now actually very rarely follow, but they used to follow before, which is the calendar year concept, Jan to December. But now almost all of them follow the financial year concept, that is April to March. So without opening and closing my books of accounts, especially closing my books of accounts at regular intervals, if I don't close it by 31st of March of every year, I don't get a clarity of what's happening in my business. What is my current financial position? And comparatively to the previous year, in the current financial year, what is the financial position? Nothing can be made. It does not facilitate any comparison, any analysis, nothing can be made, provided I close my books of accounts at regular intervals of time, and that is accounting period assumption. Third we have is a going concern assumption. A going concern assumption, simple. It's assumed that the entity will exist for a longer period of time. Accordingly, the accounts will be maintained with the assumption of not to close the operations of the business at a future date. Now, I'll go back to the Reliance example only. Yes. Now, in the Reliance Industries, now who was the founder of Reliance? Who was the founder? Mukesh, Anil?
Mukesh Ambani.
Yes, Pa?
Ambani.
Which Ambani?
Mukesh Ambani.
Mukesh Ambani. Any other answer?
Could you please repeat what you just told? I couldn't hear you.
Yeah. So who was the founder of Reliance Industries?
Dhirubhai Ambani.
Dhirubhai Ambani.
Yes, it is Dhirubhai. So now, is Dhirubhai Ambani still alive? No. Yes, he's deceased. Now, just because Dhirubhai Ambani, the founder of Reliance Industries, is no more, is Reliance Industries closed? No way. It is earning huge billions, trillions of profits even today. Yes. So, even though the founder of the business is no more, or he even though he's there, he's physically and mentally not able to maintain the business, whatever it is assumed that, okay, fine, the founder is not there no more, but his sons or daughters or any other relative or family member or friend will carry over the business. It is assumed. Yes, Dhirubhai is not there, so no one needs to communicate that fine. If Dhirubhai is not there, will Mukesh carry on? It is assumed. Dhirubhai is not there, Mukesh and Anil will carry on. Once Mukesh and Anil cannot handle it anymore, their sons and daughters like Akash, Shloka, they will carry on the business. So it's just successors of the business. So that's going concern assumption. It is assumed that the entity will exist for a longer period of time. Accounts will be maintained with the assumption of not to close the operations of the business at a future date. So it's a going concern. It will not be closed shortly. Last we have is a money measurement assumption. Money measurement assumption is damn simple. It's extremely simpler to understand. What's a money measurement assumption? Money measurement says whatever is measurable in terms of money only is recorded, right? Even though it is 1 rupee or it is a lakh, whatever is expressed, measurable in terms of monetary aspects only will be recorded. They will only find a place. Other than that, those transactions which don't involve any monetary aspect will never find a place in the business books of accounts. I'll give a small example. Let's say you get a job, okay, in one of the companies. You work for a certain period of time, okay. So once you are done, then you're not able to manage the work. A lot of work pressures. You're not happy working over there. Now, will the same be recorded in the company's books of accounts? She's not happy working over here. She's not satisfied. No, no ways. You decide one day to resign, to leave the job. So, what is the last salary paid by that company to relieve you from your work? That will be recorded in the business books of accounts. Yes, because it is measurable in terms of money. So, that's only your money measurement assumption. Now, I am a service provider. I provide my services to one of my close friend. I don't charge any fee from him. Can I record the same in my business books of accounts? Not at all, because I am not charging any fee. There is no consideration involved. Henceforth, it doesn't find a place in my business books of accounts, so it cannot be recorded. So this is called as money measurement assumption. So only those business transactions that can be measured only in terms of money are recorded. I have here given a small example that employee satisfaction is not expressed in monetary terms, henceforth it is not recorded. I hope all of you are clear with these accounting assumptions. We had discussed accounting entity assumption, accounting period assumption. We have going concern assumption. We have money measurement assumption. Yes. So now we have discussed basics of accountancy, accounting, terminologies, accounting assumptions. So before I start accounting concepts and principles, you can take a 5-minute break and then we can resume the session. Yes, so let's resume the session back after a short break. Yeah, so we had discussed about the accounting assumptions, right? So now we'll move on for the accounting concepts. So accounting concepts, we have a few to discuss, right? So first of all, we begin with accrual concept. So what does accrual concept says? That transactions are recorded on the basis of income earned or expenses incurred, irrespective of actual receipt or actual payment. So this is the concept which is followed almost by all the business entities. What is it? Accrual concept. Now, moment any, let's say, the best example we can give is a credit purchase. Yes, moment any goods are purchased from a supplier, the goods are received immediately. Yes, payment is made later. Now, moment the purchase happens, what a business does it wait till the payment is made to the supplier, or as soon as the purchase transaction takes place, it would record the same in its business books of accounts? What it would do? Would it wait till it receives the actual, makes the actual payment? No. Moment any business, a purchase transaction or purchase activity takes place, it will record the same immediately in its books of accounts. Then, of course, after a couple of days, let's say after like a week or so, or after 3-4 days, the payment is made to the supplier. Again, at the time of payment to the supplier, again it is recorded. Yes, the payment entry is recorded. So as soon as any transaction occurs in a business, it is immediately recorded, irrespective of actual receipt or actual payment. That's called as accrual concept. So second we have is this a dual aspect concept. I hope accrual concept is clear, or if it is not clear, you can let me know. Yeah. So I hope it's clear for all of you, accrual concept. The second we have is this a dual aspect concept. Now, before we talk about the dual aspect concept, which is a common system of bookkeeping, we use it as double entry system of bookkeeping. Yes, all of us debit one account and we credit another account. Yes, all of us do that. One debit is involved and one credit is involved. That's nothing but double entry system of bookkeeping. So now how this double entry system of bookkeeping evolved, came into force? Obviously, because of this dual aspect concept. So dual aspect concept was the base, was the foundation for the evolution of a double entry system of bookkeeping. So every financial transaction has two aspects, where the business receives the benefit, where the business provides the benefit. And this also forms the basis of a double entry system of bookkeeping. That's where we see, all of us, that one account gets debited, another account gets credited. So this was the concept which evolved, or which formed the basis of double entry system of bookkeeping. Next, the next accounting concept we have is this full disclosure concept. Now, what's this full disclosure concept? It says the financial records of a business concern give a true and a fair view of the firm's financial position. So I'll repeat it again. It explains that the financial records of a business concern give a true and a fair view of the firm's financial position, which means whatever takes place in the business, whatever activities takes place in the business, it has to be recorded in a honest way. Yes, because it will have a lot of reliability, in the sense all are third parties, nothing but the stakeholders. I gave an example of the suppliers, the trade unions, the customers, the government, the shareholders, investors, competitors, all of them are more or less directly or indirectly associated with the company. Yes. Now, whatever takes place in the business, whatever transactions, if I try to manipulate them, right? If I try to misappropriate my entries, what can happen? They will not rely on my entries. Yes. So once the trust is broken, obviously my business will be brought to an end, right? So whatever happens in the business, whatever activities take place, they must be recorded in a sincere way. That's nothing but full disclosure concept. So which gives a true and a fair view of the firm's financial position. The next one we have is a historical cost concept. Now, historical cost concept is this states that the assets shall be recorded at the same value at which they have been acquired for and not at the current market value. So historical cost says assets shall be recorded at the same value at which they have been acquired for and not at the current market value. Yes. Now, this historical cost concept is an exception for a few assets, not for all. Most of them, the historical cost concept relates or is applicable, but for some of them, this cannot be applied. Yes. Now, if I talk about the motor vehicles, machineries. Now, all these are subject to depreciation. Yes. Let's say this year only, in the previous month, in the July month, I had purchased a car for the office use, and for certain reasons, this month I plan to sell. Only 1 month. Last year, the company had purchased a car for the office use, and this month it plans to sell out. Now, the company would get the same value at which it had purchased the car. No. Yes. Why? Because it is subject to depreciation. Yes, even though there's only 1 month involved, but still, he will not get the same sale proceeds, as when he had purchased the car. Yes. So in such cases, now here, if we have to record the same in our balance sheet, now balance sheet we see, right, where we record on the asset side, we normally find this entry where we record the motor vehicles less depreciation. Now let's assume that the current market value of the car is different. In the sense, when the car was purchased by the company, it costed around 5 lakhs. Yes. Now, in this month, there's a small increase in the value. Let's say it is 5,50,000. Now, which will find a place? 5 lakh or 5 lakh 50? Can we record the cost of purchase or the current market value? We will take into consideration as cost of purchase. Then we deduct the depreciation. In case if any additions are there, we add up and finally we get the net amount. Yes, this is the procedure we follow. So we don't consider the current market value. But if you take about land and building, if you take about jewelry, this concept is an exception because we have to consider the current market value. Yes, at which it holds, right? So this is the historical cost concept. The next concept we have is verifiable and objective evidence concept. The word looks very, elaborative, very big, but the meaning is extremely simpler. Verifiable and objective evidence concept says that this concept requires that all financial transactions has to be supported with a documentary evidence. Now, a simple example. Now, what is the proof I'm traveling by a bus? It is a bus ticket. If I'm traveling by metro, again a ticket. If I'm watching a movie in a theater, again a ticket. If if I'm going to any amusement park, or anywhere, right? A zoo or whatever it is. Again, a ticket or an entry ticket, whatever it is, right? There is a document. I'm purchasing, land. So I'll have the agreements with me. So whatever activities or transactions take place, all have to be supported with the documentary evidence. So there is no proof of purchase or sale. There is no evidence that this financial transaction has literally happened, right? So suppose you go to a mall and you purchase any dress material. So without before leaving that particular place, you don't forget to collect the invoice, right? Yes, all of us do that. We don't forget to collect the bill or the invoice. Why? Two reasons are there. One, it's a proof that you have purchased. Second thing is, in case of any damages you find, in case. Now, to return it back to the shopkeeper, what happens? Invoice is required, right? And without the proof of invoice, he will not even agree to take it back or replace with another dress material. Yes. So it is nothing but verifiable and objective evidence concept. So this concept requires that all financial transactions has to be supported with the documentary evidence. So until here we have done accrual concept. We have covered dual aspect concept. We have full disclosure concept, historical cost concept, verifiable and objective concept. Yes, we come to the last two, which is matching concept and revenue realization concept. Now, if we talk about the matching concept, what does matching concept say? Not the matching concept which we practically follow, not that. So the companies follow matching concept in a way. So what is that? Now, which is our previous financial year? It is 20 and 21. Yes. 1st of April 20 to 31st of March 21. Yes. Now, whatever expenses is being incurred. Yes. If you have any doubts, if you have any questions, you can raise, unmute yourself and ask, or you can put it in the chat box. Otherwise, don't unmute yourself. So if we talk about the matching concept, what does matching concept say? Now the previous year, as I told, it is 1st of April 20 to 31st of March 21, right? Now in this year, whatever expenses are being incurred and incomes are being earned and incurred, the same will find a record in the financial statements of 20 and 21 only. 1st of April 20 to 31st of March 21. Whatever takes place in this financial year, that is 21 and 22, will find the place in this year itself. Now, suppose if the company forgets to record a few entries in the previous financial year, if it tries to record in this current financial year, what can happen? There can be a disturbance, there can be a chaos, there can be an imbalance of the financial statements. It will not give any clarity. Yes, so all these situations the company can face. So whatever happens in the previous financial year has to find a place in the same year. Whatever happens in the current financial year has to find a place in this year itself. So there should not be any mismatch or mixing of the expenses and incomes between different years, right? Of course, this concept is an exception to the payables and receivables. Yes, I will not include that because in case if any outstanding, or prepaid or pre-received, any kind of expenses and incomes are there pending, payables and receivables. Of course, those will be carried forward to the next financial year, except then the others which are actually paid or received they have to find a place in their respective financial years, because until and unless I record them in the respective financial year, I can't compare my financial statements. Yes, comparison can't be done. It is difficult. So this concept states that the revenue earned and the cost incurred to earn such revenue need to belong to the same period, and hence they need to be matched. This helps to ascertain the results of the business operations on a periodical basis. The next one we have is revenue realization concept. Now, revenue realization concept is revenue is considered to be the income earned on the date it is received. In other words, unearned or unrealized revenue will not be taken into account, which means revenue realization concept is the opposite of accrual concept, not dual aspect, accrual. Accrual and revenue are the opposites. Now, what does accrual say? Moment any transaction takes place, I will record it immediately in the books of accounts. Yes. Then again, if any actual receipts or payments take place, again a record would be made. But revenue realization concept is the opposite of it, which means outstanding or pending payables or receivables will not be considered. What is actually paid, what is actually received only will be considered. Rather, I can say cash basis of accounting concept. So the best example can be given of your educational institutions, right? Without the fees payment, of course, you won't be admitted for the class. Hospitals, theaters, or anywhere. So where there is a receipt of the payments, and then admission is made or entry is made, or however it is. So there is no like you're going to finish your graduation and then you can pay the fees at the last. But it doesn't happen. No. So they're all the revenue realization concept. So revenue is considered to be the income earned on the date it is received. Unearned or unrealized revenue will not be taken into account. So here we end the accounting concepts. So which all we had discussed? We had discussed accrual concept, dual aspect concept, full disclosure concept, historical cost concept, and verifiable and objective concept, matching concept, and finally we had revenue realization concept. I hope it's clear to all of you, or any concept is not understood well, you have any doubts, you can raise your questions. Okay. Yes. So next we go for the accounting principles. Now here we have 4 accounting principles. We have cost benefit principle. We have materiality principle. We have the other 2, which is consistency and prudence or conservatism principle. Now, cost benefit principle is very simple to understand, right? Cost benefit principle says whatever cost is being incurred for carrying on a business activity, it can be a sale, purchase, or any other business activity, whatever cost is being incurred, the cost has to be comparatively lesser than the revenue earned from that business activity. Yes, so cost should be lesser than the revenue earned or the earnings from such business activity. That's all. Cost should be less than profit. That's it, is cost benefit principle. So cost incurred for applying an accounting principle should be lesser than the profits derived from doing so. The next one we have is materiality principle. What is materiality principle? Actually, materiality principle and full disclosure concept almost have the same meaning, right? Almost have the same understanding. Now here, materiality principle says that all the information that is disclosed in the financial statements should aid the interested parties in arriving at the decision. So whatever accounting entries take place in a business, the same should find place in the books of accounts without any manipulation. If you have heard a concept as window dressing of financial statements. Yes. So what does window dressing means? Simple. Now I show a profit figure which I would have not received. Actually, I would have made a profit of around 10 lakh, but in my financial statements, I show it as 50 lakh for the reason of raising more capital or have more of investments. Yes. So this is nothing but window dressing, manipulation of the accounting entries. If that is done, as I told, the third parties, the stakeholders will not rely on the business, and obviously the business connection will be terminated. So that should not happen. So whatever information is disclosed in financial statements should help the parties in arriving. If they have to invest in a firm, it has to help them. If they have to enter into any business agreement, so all of them would be possible provided there is honesty and sincerity in recording the financial information of a business. Okay. So this is the second principle. The third one we have is the consistency principle. Consistency says whatever practices, whatever approaches, whatever principles the company follows, it has to be as far as possible consistent. There should not be changes. I'll give you a small example. Now we have so many methods of depreciation, right? We have straight line method, we have a terminal depreciation, we have a WDV method, yes? For the first year, if the company follows a straight line method of depreciation for its assets, for the second year, it plans to change to a terminal method of depreciation. For the third year, if it goes to a WDV method of depreciation, can the assets be recorded in an appropriate way? No. Why? Because each and every year, if I keep changing my methods of depreciation, what can happen? One of the example. So whatever methods are followed, right, by the business, it has to be as far as possible consistent. So why? Because the more I'm consistent, the more I can compare my financial statements. Yes, I can know my graph, where the company is, where the company stands. Comparatively to the previous year, is the company in a favorable financial position in the current year or needs to improve? Or is it consistent enough? There are not much of changes. Yes, all this is possible, provided the company is very much consistent in its financial practices, accounting practices, and policies. Changes are welcome, but frequent changes should be avoided. That is what the consistency principle says. Right? So the last principle which we discuss under accounting principles, we have the prudence or the conservatism principle. Now, before I talk about this prudence or conservatism principle, I would like to ask you one simple question. Now, your mother secretly saves some money. Yes? Do you all agree?
Yes, ma'am.
Yes, without your knowledge, without your dad's knowledge, without anybody's knowledge, either in the kitchen or somewhere else. Yes, all of us know it. What may be the reason? Why she will do that? I mean, the most appropriate reason I can say. What can be the reason? Any answer? Saving, I got yes, one of the replies. But the reason should be what? Why she will do that? Why?
Ma'am, to
Because
use it in a emergency purpose.
yes, they use it for emergency purposes because suddenly some situation, we may face, some emergency came, then this amount of money can be used. She'll get that thought, and then obviously she will have a secret savings. Yes. So why can't the business also have the same mindset? Yes. See, we need not see any other example. We have this pandemic only, right? Yes, COVID. Sudden lockdowns were there. lot of business firms got disturbed. There was a huge, a ripple in the business. Never expected, right? This would happen. So it is one of the biggest uncertainties all of us are facing. So in such uncertain situations, such contingent situations, if the business would have made some reserve of money, to survive in such situation, yes, it would have survived or come out of this situation. Otherwise, if it would have not reserved or saved some amount of money, not created enough provisions or reserves, what can happen? Of course, there is a close down of the business operations. It would find it very hard to manage the business. Yes. So, prudence or conservatism principle is what we define for it. So, uncertainty is involved in the operations of the business. Yes. Anytime, anything can happen. Uncertain. It requires that the business makes provisions for probable losses but operates by anticipating profits. Yes, business can expect profit. Yes, I'm going on a reasonable amount of profits, but no business says I will also incur loss. I may incur loss, but I will incur loss. No business will say, right? So, in case if such losses happens, sudden losses, sudden emergency situations. That time, business will reserve some amount of money as nothing but provisions. All of you have used this, right? Commonly, we record them. Provisions for depreciation, provisions for taxation, yes, provision for bad debts. So provisions are created for expenses and losses, but no provision is created for profits. Obviously, where the profits are transferred, like we have retained earnings, we have reserves and surplus. That's different. But to face the probable losses in future, the company or the business will create provisions, right? So that is prudence or conservatism. So all of you are clear with these accounting principles? No doubts are there? I hope it's clear. So far we have done with accounting assumptions, accounting concepts, and we have accounting principles, starting with accounting basics and accounting terminologies. Yes. So before I go for this double entry system, because that requires a link between two concepts. One we have is dual aspect and the double entry. I'll come back to this later. Yes, so this we will discuss and then we'll go back to double entry. We have source documents for accounting. Source documents is nothing but proof that a transaction has taken place. Yes. Now, as I told, if any business transaction has to take place, there must be a documentary evidence, right? As I've given an example of a ticket, a receipt. Yes, that's nothing but source documents for accounting. It serves as an evidence that the business transaction has occurred. There is no proof of any transaction has happened. Obviously, it can't be recorded, or even though if it is recorded, it will be under suspense only. Yes or no? So henceforth, every transaction or every activity requires a documentary evidence. So a source document contains details like the date of the transaction, the goods sold, amount, and the party involved. So you see in a bill, right? Commonly we have the date of the transaction, then the consignee details, then the description of the goods, value of the goods, and all this, including the tax amount. Yes. So I've given a small example, a list of documents here. The bill or the invoice. Yes. We have check. Yes. In the check, all details are appearing. Then we have a credit note and debit note. I'll just give you a small insight. Later, when we pass the vouchers, you'll understand much better. Debit note actually is used for a purchase return. To record any purchase returns, we use a debit note. And to record any sales returns, we go for a credit note. Then, of course, we have receipt, yes, and vouchers. Of course, vouchers are used by the accountants to record all kinds of cash purchase, sales, any kind of transactions normally used. source of documentary voucher. So these are the source documents or documentary evidence for any business transaction. Yes. So all of us have covered this where golden rules of accounting. In your PUC, right? First and second PU. So degree, these rules are not taught. So all of you are evident. So I'll just go for a small, round of these golden rules. Why they are defined as golden, why they are called as golden rules, you'll come to know when you start, passing your entries in Tally. Until and unless, now just with a small discussion, of course, you'll have the importance, but the importance is realized when we pass the entries. We have three, yes or no? We have personal accounts, we have real, and we have nominal. So if we talk about, I'll talk first about the personal account. Personal moment it says we go for a person, right? Personal person. Now again in this person we have two. We have three rather. We have natural person, we have artificial person, and we have a representative personal account. So I've given at the bottom that this rule is applicable to persons, artificial and representative person. Example like Aman, we have Ram and Sons, we have HAP stores, we have State Bank of India, we have outstanding salary, representative persons, prepaid expenses, etc. So all these find a place where personal account. Now what is the rule of personal account? It is debit the receiver and credit the giver. Next, we have real account. Moment we talk real account is equivalent to assets. That's it. Personal person. Real account we have is assets. So it is applicable to all assets of the business. So again, assets we have, a huge classification, right? We have tangible assets, we have intangible, in that we have is fixed current assets. So it goes on. So moment we talk about the assets is equivalent to the real account. Example I've given as cash, land and building, plant and machinery, then furnitures and fixtures, trademarks, etc. So all these are covered under real accounts. Now, trademarks, license, copyrights, royalty, what kind of assets are these? How can we define them? As fixed, current, what? What are all these? Know-how, patents, trademarks. They are assets, but what kind of assets are these?
Intangible assets.
They are intangible assets. Yes, your goodwill and everything. So last one we have is the nominal account. Moment we talk about nominal account, of course, nominal account is equivalent to your trading and profit and loss entries. I would like to give you a direct equation that whatever entries you make, except the opening and the closing stock, okay, so the rest, trading and profit and loss account, whatever expenses you cover, can be direct or indirect in nature, and same way incomes and losses and profits, all of them are covered under nominal account. So this rule is applicable to all the expenses, incomes, losses, and profits. So here I've given an example of salary, wages, purchases, sales, commission received, etc. So the list goes on. So as I told, your trading and P&L account is a best example, or rather a direct equation for your nominal account. So what does the rule of nominal account say? All expenses and losses we debit, and we credit all incomes and profits or gains. Yes, so as I told, I would do the double entry system once we go for the next session. I would start that and then I'll begin with the tally aspect. So how was your first session? I would like to know. Was it a revision round? Was it a small?
Excuse me, ma'am.
Yes, ma'am.
Ma'am, I'm not added to the group. I asked my friend to send a link. I could join just now.
Okay. The meeting is actually being recorded for your future references, and you're not added in the group?
No, ma'am.
Your name? In 1 minute. So what you can do is, you can do one thing. You can just request your coordinator. I think she'll add it in the group. Okay? You can take that step. You can just ask your coordinator to add you in the WhatsApp group. Fine? Would that be okay?
Okay, ma'am. Yes,
Yeah,
ma'am.
it will be better. Yes. So the meeting is recorded, which is available for your future references also. So there's nothing to worry of that. Okay? So just cover whatever you have done so far.
Ma'am,
Any other
I'll ask my
question?
coordinator, right?
Yes, please.
Okay, ma'am.
So any other question? So how did you feel the first session? Good, bad? How was it? I would like to know.
Good, ma'am.
Good,
Yes.
ma'am.
So a small refreshing session. What all you would have done in your PUC, long back, all all is coming before you now. So why this was done, as I'm telling it and repeating it again, that all this only you will use in Tally. So next, okay, fine, it's so easy, like in pass the entries. Yes, if this base is strong for all of you, ultimately, whatever entries we start passing in Tally software will be very, very easy. There'll be no issues. So how you base yourself in accounting, you will be reflected in Tally in a better way. Yes. So I hope the session was useful for all of you. The first session.
Yes, ma'am.
Yes.
Yes, ma'am.
Okay. So in the upcoming sessions, we will begin with the use of the Tally software. How can we download it? So provided all of you have your desktop or laptops ready, so that, of course, right now also you're into that, but we have to download the Tally software in the upcoming sessions. So make sure you are ready for the same. Okay. So hope you have a nice day. So, see, meet you in the next session.
Thank you, ma'am.
Thank you, ma'am. Thank you, ma'am. Thank you, ma'am.